am an economist, actual degrees in economics. Spent 35 years studying the economy of the city of New York. Or as I like to put it, 3 financial crises and major downturns followed by jobless recoveries. You're hearing about jobless recoveries. They started saying it in the 90s. Right? That was a jobless recovery. Right? And then we had a jobless recovery the last time. And we had a jobless recovery this time. Except they're not jobless. The really fun part is I start with the really upbeat news. This starts all my presentations. This is just how New York City performed in terms of percentage change in jobs. This is all private sector versus the US. And you're out there and you're talking to your clients and they're constantly telling you how awful things are, and they're right, it's pretty bad. And now you have to remind yourself, we did a lot better than the US. Much better than the US. They started down nationally much earlier, went negative much earlier, percentage losses much bigger, right? New York City recovered faster, went back positive growth sooner, hanging above the US rate most of the last few years. By the way, that's the jobless recovery. That's like 4 straight years of job growth. So we are getting job growth. One of the joys of this labor economics is that you don't get to stand still. The last national job numbers they put out, they announced that we were finally back where we started. That the job count was back to where it had been at its peak before the downturn. So that's 7 years earlier. And unfortunately in labor economics, it's this terrible thing. You're out there for 7 years and you're going sideways, and people just insist on graduating high school and college. Every year they come out, and they want jobs. They're really greedy that way. Just come out, gotta have jobs. And people come here from other parts. We're actually gaining population. New York City gaining population, and a lot of the people who move here are college educated. So people graduate college and they come here, and they want jobs too. It's completely unfair of them, I know. And the city's job market, strong, really strong. And I told you the nation got back to where it was finally. We got back to where we were before 3 years ago. The crossing point for the New York City economy happened back in 2011, right? More jobs, far more jobs in New York City now than there were back in 2007. On the order of hundreds of thousands more jobs. And yet the unemployment rate's higher now than it was then. Right? Well, first of all, the unemployment rate only measures New York City residents. That unemployment rate you see when they do the release. And of course, not just New York City residents work in New York City. And we've had this lovely, strong economy, and it's attracting people. And they come here. They come from the regions all around. The New York City, by the way, and I've been doing this a long time, so I had to adjust my view. I mean, when I started covering the city, of course, 1979, 70s are interesting. There was this little downturn that hit New York City, which I refer to as losing Buffalo. The city lost jobs for 8 years in a row from 69 to 77. Lost more jobs than there are people in Buffalo. And if you were here in the early 80s and you asked people about the city's economy, it was always like, oh boy, terrible. Things will be awful, forever. The cities are all spiraling downward and we're just done, absolutely done. And then we had a sort of a decent period in the 80s. And then, of course, there was a big recession in the late 80s, early 90s, really hammered New York City. And then we had another recovery in the 90s. And that one was pretty good. We had some real good times there. And the unemployment rate in the late 90s got really low. And then, of course, we had a national downturn compounded locally by 9/11, which certainly affected our labor markets. And everyone again was like, well, the city, who'd want to live in a city? Terrorists target cities, The internet's going to, that was the other one, the internet's going to destroy the cities. Why? If you can do it from anywhere, why would you want to do it from a crowded, expensive, polluted place? And we'll all work from Caribbean islands. That's it. We'll all spread out. We'll be everywhere. We will not be crowded in New York City. And that didn't work so hot either, huh? Because here we are again, another strong job market, tech jobs all over the place, the city's economy doing really well. So I've, over time, become more optimistic. I mean, economists in general are kind of pessimistic, and I'm sort of a pessimistic sort of guy. And you know, as you came by and the economy kept coming back every time they do, oh, the city's finished, you know, oh, terrible, never come back again. And then we soar back again. So the good news is we're actually in a long-term uptrend. And I know when someone's trying to find a job next week, telling them that, you know, Jim Brown says things just keep getting better. Every cycle's stronger than the last one. And 5 years from now, things are going to be wonderful. It isn't much, but you should keep it in mind that in general, it's a positive job market and that the city has been outperforming the nation and that we're doing really well in job creation. Now, job creation, wonderful. We're talking about tech. So I ran some tech numbers. And the thing is, when you say tech, of course, people all get this look on their face. They call me all the time and they go, how many people work in tech? And I sort of look at them like, well, what do you mean by tech? And most of the time when people say tech, the first thing they're talking about computers. But tech's all over the place. The federal government has a list of high-tech industries that's based on industries that spend a lot on research and development. If you're high-tech, you must be spending a lot developing your products. It's an intelligent way to measure it. It also includes lovely things like defense electronics, which you might think of as tech. The pharmaceutical industry, which you know is a little broader. People who make perfumes and detergents, they spend a ton of money on research and development. You know, so that each year they can tell you that their products are better. You know, they work differently. They spend a ton of money on it. Or oil drilling companies, they're investing a ton in technology. So when you say tech, it's what do you want to measure? So for this, I did mostly, this here is just the computer tech. So it's your software publishers, your data processing companies, the firms you keep reading about in the newspapers, the ones that keep saying they're expanding around here, Google, Facebook, Yahoo, whatever, on they go. And you got pushing 100,000 jobs. And on the top of it is this tiny little slice, tech manufacturing. We are not a tech manufacturing center, in case you had any doubts. There are no giant semiconductor plants, no computer assembly plants. We are not in that business. We are in services, and it's almost all software driven and whatever else. And you'll see it has actually recovered quite nicely. In the early part of the decade, got hit pretty hard. Now this is one definition. It has not quite 100,000. You take a broader definition, what about biotech? Is that tech? You know, what about all the media and advertising stuff? You know, what's that? A broader definition, and there was a report put out not that long ago, Google and Citibank and a whole bunch of other people participated, hired some company called HRA Advisors, and they took a much broader view in tech and counted just about everything you could think of as tech, media, advertising, whatever else. They got about 250,000. So when people say how many people are in tech, it's like, who's counting? Close to 100,000 in the computer stuff. More like 250,000 if you take a broader view. And the other thing to understand is this, an index going back to 2000. Tech got hammered. .com bust, you know. Tech got hammered in the previous downturn, but barely had a downturn this time. 1 year down, relatively small loss, off to the races. It's pushing 35% above where it was in 2000, which was the height of the .com explosion. And I can, because I do all this and I live through all this, 2000, 2001, 2002, 2003, and the news is bad, and everyone's there telling me, tech is dead. We're never going to be a tech center again. We missed our shot. You know, they had all these lovely .com companies, and we didn't get the winners. And the part of it is, it's almost luck. I mean, they had this giant boom, and that's the way capitalism works. Thousands and thousands of people had brilliant ideas, and the time was right, and the money people got behind it, and Wall Street raised a ton of money and put it into all these startups, mostly, websites, and most of them failed. That's the way capitalism works. If you go back to when the car was the leading edge company, there were hundreds and hundreds of car companies, and they almost all went broke. And now, the car reshaped America. Car was probably had at least as much impact on the economy as the internet and such are having. Completely reshaped America. Really crucial economic product that at one point was driving our economy like crazy, and most of the companies went broke. Most people who invested in car companies lost their money. And a few came out really successful, and then it spread all over the world. And we went through this web boom. We had all these tech companies, websites popping up, and what happened? Then it went bust. And when the smoke cleared, by the way, if you had asked people in 98 or 99 to pick the winners, they probably wouldn't have picked things like, well, there's going to be this online garage sale called eBay. They'll be a big winner. Or this guy's got a company out there on the West Coast, and when he's finished, he's going to put all the bookstores and record stores out of business. When the smoke clears, he's going to be selling more books and records and whatever else. Oh, Amazon, yeah, right, those guys. Could have been BarnesandNoble.com. They were here in New York City, employed hundreds of people, doing quite well. Didn't work out. They weren't the big winner, Amazon was. eBay's not based here either. So that early web boom, and not that we didn't have some winners, we did, but we didn't have big winners. And when it went bust, it really hit us, and they said tech was never coming back. But in fact, tech came back really strong. And some of it is, it turns out, and this is something they know in economics, but they forget every time we have one of these revolutionary changes, is that people like to cluster. People in like industries like to be near each other. And they benefit from doing so, which is why you find concentrations of industries in different cities. As you get them together and they get a critical mass, and the next thing you know, they're talking at the street corner while they're buying hot dogs from the vendor, and ideas are popping up. And they're meeting for beers after work and whatever else, and new companies are being born. It actually makes a difference. You get this clustering effect, and it seems to be working for internet companies too. And for tech companies in general. They work better when they cluster together. Yes, you could be sitting on a Caribbean island, doing everything by the internet, but you wouldn't be meeting any of your fellow industry participants. So it does appear to benefit the city that we cluster. I mentioned before advertising and media. One of the reasons New York City has actually done as well as we have in this upturn is we are successfully transitioning from old media to new media. I mean, we're a center of old media. We were newspaper publishing, book publishing, magazine publishing. 5 of the 6 major TV networks were based in New York City. I mean, we were old media. Radio companies based here. Lots of advertising agencies, Madison Avenue. I mean, I sometimes tell people you can pretty much do New York City's economy by the streets. You got Wall Street, you got Fashion Avenue, you got Madison Avenue, whatever. There it is. They could have lost out. I mean, completely. The advertising industry in particular could have lost out. New advertising firms could have popped up somewhere else, taken all the business away from them. Our advertising firms have done a reasonable job of adjusting, of getting to selling the new kinds of advertising, taking advantage of the new advertising tools, more towards social media and online marketing. And these industries are being reshaped. Now, one of the issues there, of course, is if you're working in that reshaping industry and you have the old skill set, maybe they got rid of you. And one of the issues we've had in labor force is you get people, middle-aged, even older, they have a lot of work history. They think they're high level. They have years of progressively higher paying jobs within an industry. But when you look at the resume, they know how to do things the old way. It's all about old, newspaper publishing, magazine publishing, classified ads, whatever else. It's all about operating in the old environment. And it can be really tricky trying to convince someone like that that their old experience doesn't translate at the same dollar value. And the other problem is, of course, it gets mixed up with age discrimination. You go in with what you think is an impressive resume. The person on the other side of the desk, who happens to be 20 years younger than you, isn't impressed at all. And it sure feels like age discrimination. And I'm not going to say that doesn't exist, but a lot of times what you're dealing with is maybe the customer doesn't realize the degree to which the industry they're operating in has changed. And one of the things that happens in downturns that's really crucial is that's when you find out about tech deficiencies. People may be working in a company and sort of doing fine, and then they get laid off, and when they have to sell themselves to another company is when you realize what they don't know how to do. And it's been going on forever. I remember in the late 80s, early 90s, we had a huge wave of layoffs out of the banking industry. And they had a lot of executives who would tell you they understood tech, office technology. And it turned out what that meant was they knew which secretary or administrative assistant to give which project to. Couldn't do any of it themselves, but they knew who could do spreadsheet, who could do word processing, who could do whatever. So they thought they were on top of tech. But of course, as we went along, people wanted executives to be able to sit down at their computers and do it themselves, use that technology themselves. So if you don't have that skill, and you find it in office work all the time, you may think you're proficient in office and you're getting along, but then when you have to sell yourself to a new employer, well, they're holding you to a higher standard. You were good enough to hang on to your job until you weren't. Maybe it wasn't even your fault. The company just got in trouble and bodies had to go. But now you're out on the street and you're trying to sell yourself, and the hiring standard is higher. The industry has changed while you weren't there. And it's happened, it's an old story. It happens over and over again. We went through a big transition when everyone started doing graphic designing on computers. And we had more than one. We had the big downturn in the 90s, the early 90s, the late 80s. People out of work for a few years. I'm a graphic designer. Well, can you use, can't remember what the Apple product was at the time. But all of a sudden, everyone was doing their graphic designing on Apple computers. And they didn't even know how. Didn't matter that you had 20 years experience. You weren't employable or not employable at the same level. So the tech keeps changing. And our companies have actually done a pretty good job of transitioning. And the other thing is, because we are a center of advertising, because we are a center of media, we're attracting a lot of startups. One of the things that's driving the tech scene in New York City is companies who are trying to get new technologies or use new technologies for our old industries. So advertising is a huge driver. I mean, most of the internet makes their money on advertising. Everyone thinks of Google as search and their Gmail and whatever else, but what drives their revenue, of course, is the money they get paid for those search terms and for the ads and whatever else. Advertising is what drives them. And so, one of the first things Google did when they started developing a real position here was they bought DoubleClick, which was an early online advertising company. And that gave them a big footprint, and they started expanding. So you see that kind of thing, companies springing up here, growing here, to work hand in hand with the existing advertising infrastructure, or to try and develop new tools that they then sell to them as they're trying to transition into the new marketplace. And something similar is going on in finance. We've always had a tech finance industry, which mostly was concentrated around making the exchanges operate faster and faster. I don't know if any of you pay much attention to stock trading, but I'm going to show my age. I was into financial things from a very young age. And when I first started looking at Wall Street, they used to think they had a busy day when they traded 10 million shares. Right? 10 million shares. Now they're complaining volume is low because they're only trading 600 million. And that's just the New York Stock Exchange. And their little tech people go out on weekends and run tests where they assume 5 billion shares. And they didn't go out and hire, 1,000 times as many clerks to process papers. They used technology, obviously. They used faster computers, they used better information transfer systems, whatever. Tech has always been an important part of the finance industry in New York City. But the new thing we're seeing is we're getting tech finance, we're getting startups that are aimed at essentially providing people with technical expertise, cheap or relatively cheap. So they're affiliated with the big brokerage houses, or they want to be in some way with the investment houses, marketing, but the idea is give people online tools or build automated systems that will help them handle their investments. Because when you're in economics and you're studying job markets, you look for really big trends. Well, one of the big trends of the last probably 50 years, but certainly 30 or 40, is that more and more you're on your own. You're responsible for your retirement, and that's been coming for decades now. And now we're moving toward you're responsible for your health care. Companies are more interested in you getting a pool of dollars which you decide how to spend. So you have to make decisions. Well, most people aren't really equipped to make investment decisions. They've proven it over and over and over again. People can't manage their money. It's all fine and well to say if they sit down and do this and this and this, they'd all be wealthy when they retired, but they're not going to do this and this and this. They know it about people. You can study them over and over again. People are relatively predictable in large groups. When things are bad, they pull their money out, just when they should be doubling down. Everyone loves folksy Warren Buffett, Yeah. And he's got this lovely saying where he says he gets greedy when people are fearful and fearful when people are greedy. But of course, everyone else operates the other way, and therefore they don't invest well. Well, technology hopes to save people from themselves, hopes to get in there and give them automated systems, robotic investing systems, online advice tools, whatever else that will help them make smart decisions. So again, New York City becomes a center of what amounts to financial tech startups. So you get growth there. So this media and advertising, which is actually much bigger than the tech I showed you before, is all these industries are being reshaped by tech. It's all being driven by what's happening online and social media and whatever else. And tech plays enormous roles in industries people don't really think about. A really predictable industry that you can expect to get hammered in downturn is travel and is leisure and hospitality, the travel-related and tourism industries. It's obvious. It's discretionary spending. When the economy slows down, it's going to get hit. People will just spend less on it. And one of the things we noticed as we went through the decades was that the downturns in employment became less severe. And so why would that be? Well, one reason is tech rides to the rescue. It's 25 years ago. You own a hotel. Business suddenly gets bad. What do? Run an ad in the newspaper that you've cut your room rates? Take you a couple of weeks to get the ad in. Get the ad designed, get the ad in, whatever else. What happens, What good does it do you? People looking for a room this weekend, you're going to tell them in 2 weeks they could have had it cheap? No. But tech comes along, and then you start getting Travelocity, right? Well, now you have a cheap room, you can give it away tomorrow. Because one of the lovely things about, especially the hotel industry, is it is, in economics they give you these examples, like a Christmas tree on the 26th. Well, nothing has less value than than last night's empty hotel room. Business can't sell it for anything, at least not until they invent time travel. But now they can come out there and reach to you, and of course we got Groupon, and we got social media, and we got all these instant websites. What, you and your wife suddenly decided you want to go to New York City for the weekend? No problem, Look at this. Restaurant coupons, hotel coupons, here's a package, we'll get you show tickets for half price, and they can tell you all about it today, about tomorrow. So tech actually lets businesses react much faster to changing economic conditions. And it didn't, I mean, they had to cut prices, so obviously it affected their profit. But again, if you're running a hotel, it doesn't cost much more to run a hotel that's full than a hotel that's only half full. Those extra rooms are almost pure profit. A little more staffing costs, but you have to have a minimum staff anyway. And then there are the big costs of running the building, you know, real estate taxes, mortgage, or whatever else. You're stuck with those, whether the room's full or empty. So you can sell that next room pretty cheap. And the leisure and hospitality industries, in the last downturn, you saw it some. In this downturn, you saw it immediately. As soon as the economy started to slow, the number of deals being offered exploded. And again, it's done by tech. Tech is what makes it possible. But it's affecting this industry that you would think has almost nothing to do with tech. You know, who thinks of leisure and hospitality, which is pretty much all hotels and restaurants, as a tech-dependent industry? But their marketing has been reshaped by technology. So you get Groupon, and you get Travelocity, and you get all these instant deals, and it changes the way the industry responds to downturns. And therefore, they get to adjust their prices down and cut employment less. Instead of having to cut costs by laying people off left and right, they move their revenue curve down a little, but still make money. And it's also, by the way, one of the early examples we saw in the airline industry. I don't know how many of you are old enough to have lived through it, but at some point they deregulated airlines, and all of a sudden there were all these cheap airlines popping up all over the place, People's Express and whatever else, and they were selling tickets for next to nothing. And it was real bad for the existing airlines, and some of them went out of business. But eventually they adjusted. And part of how they adjusted was technology. Because one of the goal, the holy grail in economics, they have this lovely thing they call the supply and demand curve, you know, price, supply, everyone's seen it. What it actually is a revenue or sales curve. The goal, the real goal in that type of an industry would be to sell everyone their room, their airline seat, whatever, for exactly the maximum price they'd pay. You would get then all your revenue. Well, airlines come pretty close. They're constantly adjusting their pricing on their tickets. And they adjust it based on all kinds of things, stuff they don't even tell you about. What? You came last week and checked the same flight? Next time you come back, the price is going up a little. You're really interested, okay? We'll teach you to wait. You know, you know, all this. And they had one where someone did a test, and the result they got was if you came in with an Apple product, the prices were higher, because presumably you were more interested in quality than cheap. So they charged people who signed in through Macs and iPads and such more. You know, it's like, wait a minute. You know, they're doing all this lovely stuff. What's that? You always fly to Florida in April? Well, you'll see higher prices. You know, if they can keep track, and they're constantly, oh, we sold 2 tickets, raise the price on all the others. As the plane starts to fill up, the price, you know, or the other way around. If business is bad, prices drop as you get close. That's why sometimes you run into a situation where you bought a ticket 2-3 weeks in advance, and now they're giving them away at the door. And now, well, business wasn't so great. And the industries used this technology, the ability to track, and you heard people talking about big data before. Well, this started decades ago, and it was probably one of the earlier examples. Since they can track every transaction, since they have all this information about what happened in the past on all these flights and who did what when, at what price point, they can constantly adjust their prices. And just like Google has search algorithms, they have algorithms. Which means, by the way, it's been a great couple of decades for mathematicians. You hear algorithms, you used to think people who do high-end math. You know, so you hear search algorithms or, you know, pricing algorithms or whatever else. There's some people who have lots of letters after their names and work in numbers you don't even want to think about, pulling the information together. But again, you have to be able to do it fast. You have to be able to collect these enormous amounts of data. You have to be able to process it real fast, and it changes industries. And part of the reason I end up sounding passionate about this is someone's going to work in these industries, they need to understand it. Even if they're not directly tech, if you're marketing, if you're HR, if you're whatever else, this is crucial to that industry. You can't be interviewed to work in an industry like that at anything above a relatively low-level job and not understand how the industry operates. And in more and more industries, when you get there, the answer is tech. So I could as easily have put leisure and hospitality because their marketing has been reshaped by tech. And it's behind the scenes. And of course, the other thing with hotel industry is now you go to a hotel, you expect there to be wireless. Right? Well, someone's providing it. You know, maybe they contracted it out, but there's people hard at work making sure you have wireless in your hotel room. Now, I mentioned tech and I mentioned computer. This is a graph of the computer and mathematical occupations and which industries employ people who work in those occupations. See, before I was showing you industries. I said there's 100,000 people in tech industries and there's 150,000 in media and advertising industries. But tech is also an occupation. And that's one of the things about measuring tech. There are some industries that are just industries, you know. Banking is banking. But tech, there are lots of people who work in tech who don't work in a tech industry. This is computer and mathematical occupations. Well, obviously, computer systems design and related services is the biggest employer. Those are companies who make specialized software packages, come in and design computer systems, whatever else. Obviously, they employ a lot of computer ones. Now start going down the list. You got universities, you got insurance carriers, you got securities firms, you got management of companies and enterprises, which means corporate headquarters. None of these have anything to do with tech, except they do because they use tech. I told you about finance before. Well, universities, same thing. I'm one of the guinea pigs. I went to City College back in the early 70s. And the second year I was there, they tried a computerized matching system for getting you your schedule. It was a little lumpy, but it was a lot better than the old system where you waited on lines and then somebody looked at a little card and told you whether there were any openings left. And if you didn't, you had to move to the next line for the next class you wanted and wait to be told whether they had openings there. They went to computerized matching. So, you know, colleges use a lot of tech, you know, big colleges. And of course, what do students expect? Especially the colleges with dorms. What does everyone expect in the dorm? Wireless. Yes, they expect internet connections, high speed, good quality. You know, and of course, in their operations, because they train in it, so of course then they have to have decent tech if they're going to train people in it, and because their students expect it to be available. So colleges, big users of tech. Finance, big users of tech. Government, big users of tech to a degree. And you get pretty far down before you find the next thing you'd think of as a tech industry. So something on the order of half the people who are employed in computer and mathematical occupations don't work in tech industries. They work somewhere else. Of course, tech is everywhere and spreading. And of course, you know, they give things names. Big data gets a lot of discussion now. As we've become able to collect vast amounts of data and process it really fast, they get this idea of big data. But as I mentioned some examples before, that as we've gone along, they've come to realize the ability to gather a lot of information and process it. And they keep getting better and better at it because the computers keep getting faster and faster. And the storage capacity keeps getting cheaper and cheaper, and therefore they can keep everything. And you think I'm kidding. There's some private companies that are out there whose business is taking pictures of license plates. They have cameras up and they take pictures of license plates at various places, and they save them. And it's estimated that, you know, we're busily collecting hundreds of millions of pictures of license plates. And where they were. Well, a license plate is a public data point. Someone has your license plate number, they can see who you are. So at some point in the future, assuming all these silos were to agree to talk together, it would be possible to determine where a certain car was for long periods of time. Who controls that information? How is it used? Tech. I like to kid that I'm basically constantly monitored. My car has an Easy Pass. I use a Metro card. I have to swipe a little thing that has a GPS built into it when I go in and out of my office. I carry a work-provided phone, which has a GPS component in it. I mean, the only thing they haven't done is put one of those little tracking darts under my arm. The world knows where I am. I mean, that's all tech, and it's, you know, how it gets used, where it comes out, and it develops in a lot of different industries, enormous numbers of industries. And of course, employment services there in the middle. Well, there are employment agencies that specialize in just providing tech workers. And in fact, that's increasingly common. So again, you wouldn't think of them as a tech industry, but in fact, they are a tech industry. These are just the occupational groupings. Computer and mathematical occupations is the third highest paying cluster. Trails only legal occupations and, of course, management. Management always makes the best money. And everything else, and you'll see there's a real difference here. When you look through these different clusters, there are incredible variations in average pay. There are large clusters of workers where the average pay is $20-something thousand a year, and large clusters where the average pay is 60, 70, 80. Primary difference between most of those is education. Education is pretty much I think of it as labor market 101. If you tell me a group of people's education, I can do a good job of telling you how much money they make and what chance there is that they're unemployed. And it's consistent. It goes up and down as they all do, but high school dropouts will be 4 times as likely to be unemployed as college grads. Now, it may be that in a good year that's 8% and 2%, and in a bad year that's 6% and 25%, but you know, the relationship tends to hold, and it's very consistent. Now, I also like to tell groups of job seekers, nothing excuses being a jerk. I don't care how good your resume is. If you can't come across reasonably well in an interview, oh well. You know. But that aside, you know, assuming you are a reasonable human being or come across as such in an interview, your pay and employment opportunities depend greatly on your education, your training. Just for a general, I threw in the particular occupational projections we have. Tech occupations are pretty much all forecast to grow significantly faster than the overall job market over the next 10 years. And they pay significantly more than the median wage for all occupations. It's not quite as good as law, but in tech, there's all sorts of different things you can do. I mean, there are jobs that are much more creative and jobs that are much more mathematical. There's a lot of variation, depending on what type of work you like to do. And they're all growing faster than the general economy and paying more. So there are definitely opportunities here. And it's big numbers we're talking. We're talking tens and tens of thousands of jobs just in New York City. Now, I mentioned before that New York City had made back all the jobs it lost and a whole bunch more. Here comes the joker in the deck. We didn't get the same jobs back. Right? When you come through a downturn, they show you this net number. We had enormous growth in what's called managerial, professional, and creative, and that's where most of the tech people are. Enormous growth. There were 80,000 more jobs in New York City, and this is back at 2012. It's gotten better since, than there were in 2007. So in the 5 years that included a really severe recession and the recovery, they added 80,000 jobs in these fields. And we added a bunch of jobs in service occupations, which are primarily security guards, waiter, waitresses, those type of jobs. So we added a lot of jobs, in particularly high educated, high wage occupations, and we added a bunch of jobs in not so educated, not so high wage occupations. And here, Sales and office occupations, the big loser. You would think with a severe downturn it would be the blue-collar industries. But it wasn't. It was the office jobs, the support office jobs. And that's part of why it makes a difference when you're dealing with someone, whether they've got their skill sets up to date. Of course, it is still a very competitive market for someone trying to get an office job. There are far fewer than there were 5, 6, 7 years ago. And that's why when you talk to different people, they're going to have a completely different perception about what kind of job market is out there. If you're someone trying to get a job as a clerk or a secretary or whatever else, you still face a really serious, tight job market. Some of the other fields doing a lot better. This is all from the American Community Survey, by the way, which is an enormous wealth of information about education, training, occupations, wages, whatever else for the individuals who reside in various places. You look through the metro area, 10 counties that make up downstate New York. One thing jumps out at you. Manhattan and Brooklyn really way out in front in terms of job growth. Now, Manhattan might not surprise you because even if you count all 10 counties, Manhattan makes up something like 1/3 of the jobs in those 10 counties. So you would expect them to have, in a recovery, to have added a lot of jobs. Brooklyn's a bit of a surprise. Brooklyn has added almost as many jobs, and this is measuring since before the recovery, before the recession started. So this is after the downturn and during the bounce back. Brooklyn is plus 70,000 jobs from where they were in 2007. If you're hearing anything in the newspaper about Brooklyn is hot, they're not lying. Immense amounts of job growth taking place in Brooklyn. And if you convert this for size, so you do percentage, there's Brooklyn, the hands down winner. Well, Brooklyn is driven by a number of things. One is their developing tech sector. They have what they call a Brooklyn Tech Triangle, which is an area that has got quite a few companies going in it. You also find a bunch of tech companies in the Brooklyn Navy Yard. It's been a very successful redevelopment project, going on for a while now, but really starting to get traction in the last 5, 6, 7 years. There are thousands of jobs in the old Brooklyn Navy Yard economic development zone now. Some of them are tech, a lot of them are in motion pictures, some are manufacturing, or usually more technologically oriented manufacturing. Brooklyn has also is a center for e-tailing. The online retailers, they're big in Brooklyn. Now that's an interesting industry too, because obviously they use network administrators and database people and whatever else, but they also use customer service reps. Because part of their model is people placing orders and maybe they need support or whatever else. And it's also why I said New York City is such an attractive job market to the people in the surrounding areas. In this upturn, in this recovery, we have significantly outperformed all the suburban areas. That wasn't always true. In fact, the model I learned when I first started studying the New York City economy was the exact opposite. That over time the city trailed the suburbs. The suburbs were the high growth areas. But the last two recoveries have been the other way around. The city has been the leader. Suffolk, some of it is population growth with Suffolk, which by the way is helping Brooklyn too. Population growth is a great economic force. You pick up, you need more schools, you need more stores, you need more healthcare, you need more all kinds of things when you have population growth. More housing, very good. Suffolk has one of the few areas, Nassau's population is shrinking. Suffolk is still growing. Suffolk is also doing a very good job competing with Nassau for jobs. There's been a steady stream of relocations from Nassau into Suffolk. And Suffolk has it's tech, if you take the broader sense, a very large pharmaceutical manufacturing industry. It's over 10,000 jobs at this point. It's actually the only sector in the section in downstate New York where you find growing pharmaceutical industries. New York City has a nascent biotech industry, but the employment trends are still being driven by layoffs by the old, like Pfizer closed a plant in Brooklyn a few years ago. The old line pharmaceutical companies have been downsizing relentlessly. Rockland used to have a very big pharmaceutical industry. Pfizer and Wyeth were all up there, and they've closed down most of their factories and laid a lot of people off. Suffolk is doing very well in that particular area, particularly in generic drugs. So that's helped drive their economy. And they've also one of the few areas in the state that's adding manufacturing jobs, helped by that pharmaceutical, but other areas too. Food manufacturing is one of the few strong areas in manufacturing in downstate New York. We've seen a real shift to production aimed at serving the local needs. We have this booming restaurant industry. There's sort of a trend toward more local input of foods. So you get companies popping up making salads and small-scale commercial bakeries and such popping up to serve the local restaurant industry or to pop up in the local groceries. So we've seen some growth in food manufacturing. And of course, a lot of areas aren't doing terribly well. Westchester, Nassau, sort of lagging. Now remember, for this period, the US is flat. In fact, the US is slightly negative. So every one of these counties outperformed the US. So this is a relative scale. They're all doing better than the country. But Brooklyn doing really well. The Bronx, surprising everyone, doing quite well too. A lot of retail development, a lot of housing development, a lot going on in the Bronx, and it doesn't get talked about a lot, which makes the Bronx borough president crazy. But the Bronx, you know, Brooklyn's getting all this press, and there's the Bronx, not all that far behind. Really ripping along. Not much tech in the Bronx stuff. By the way, we're sitting here in this building. I meant to mention this earlier. I showed you the tech number, 100,000 almost. About a third of that is from, say, 49th Street down to the Holland Tunnel on the west side. There's a huge concentration of tech on the west side of Manhattan. Huge concentration. We're standing in the middle of it. This is just one I threw in for sort of general interest. This is the educational attainment. City has an interesting shaped job, a workforce. We have a lot of really well-educated people and a lot of people with less than a high school diploma. So that's part of the workforce issue we face is you pretty much have to have two strategies. I mean, one of the issues the city has dealt with is when they were picking occupations to use training grant money for, they concentrated heavily down here. A lot of the occupations they picked, the limited list they had you could use training grants for, were weighted heavily toward things you could train for relatively quickly without too much education requirements. So it was more about, you know, becoming a truck driver or some kind of relatively low-level medical tech to move people up the ladder out of that bottom grade. Because if you're, 20% of the population less than high school graduate, that's a very big number. And you can see nationally it's under 14%. It's a huge number. And you're talking millions of people in the city, so that 6 or 7 percentage point difference is tens of thousands of people who are in a significant disadvantage in the labor market, both in terms of the likelihood they'll have a job and certainly in terms of how much money they'll make. So one of the issues in workforce is where do you concentrate your resources? By the way, most of the people getting a tech certificate would be in here. It's considered something beyond high school, so it would be credited as some college or, depending on what exactly you got, it would be in there. This, by the way, is the earnings chart. They tell you New York City costs a lot, and therefore they pay their people well. But they don't pay their people well if they don't have an education. The average wage for people with less than a high school diploma is lower in the city than it is in the rest of the state. Lower. And part of that's because you saw we have a big supply of people without a high school diploma. Well, high supply lowers price. And then you move up at some college or technical degree or whatever else that you start to see big positives in the wage relative to, if you did it for the US, you'd see the same thing, except the numbers would be even more stark. The gap, the US wages are a little less than the state wages. So the education rewards you in multiple ways. You make more money, got a better chance of having a job, and you also end up doing better, relatively better, to people who are not as fortunate as you. Again, American Community Survey, a lovely source of data. And that's it.